Can you hear me, Dale?
I can, Tim. How are you?
Excellent. Very good, thanks. How are you?
Good. Great to meet you. Did you want to show anything or screen share?
No, I'm afraid I've got nothing to bring to the table. So my cupboard is bare, sadly.
Well, then what I'm going to do is I'm going to keep your, I'll get your website up here and make myself the presenter so people could at least see what you do. And I'm showing my screen now. So why don't we begin with UK politics? If you heard Blake's question, what's your assessment of what's happening with Brexit right now? And then
yeah, I mean we have there's a satirical political satirical show we used to have here called The Thick of It, written by a guy called Armando Iannucci, and he's one of probably our better satirical comedians, and he coined this phrase omnishambles, which is where absolutely everything that can go wrong does go wrong. So we had an omnishambles budget.
Murphy's Law.
Exactly, okay. Like Murphy's Law to Power 10. And I kind of feel a little bit sorry for Theresa May. I mean, I'm not really a political animal, but I have to say, I think I get the sense that she's out of her depth. I was very, very strongly in favor of leaving the EU, so I'm delighted that the referendum vote went the way it did. But unfortunately, we have a huge problem in the UK, perhaps similar to the political problem, if you can call it a problem in the States, namely that you have in your instance, you have a president who's very polarizing. So yes. I don't know if you'd concede that the US is pretty much split down the middle between people who are for Trump and people who are against him. And we have exactly the same problem here in relation to basically Leave versus Remain. So although Leave won the vote by, I don't know, 1 million or whatever it was, and that actually only equates to like 52, exactly 52% versus 48%. So it's a very cut and very, very narrow thing. Anyway, the point about Theresa May is that she was a Remain supporter, and she's been asked. So we're asking a Remainer to do a Leaver's job, and that was always going to be problematic. And I won't name the politician who said this about her, but one of the best political speakers we had in the UK, he's actually an MEP, a member of the European Parliament, not a member of our own Parliament. But he said the problem with Theresa May is that she's got all the charisma of a broken speak your weight machine.
Wow. Okay.
And bear in mind, he's actually a member of the same party, the Conservative Party, and so this is the problem, that you have someone who's I nurse no ill will at all towards her as a person, but I think probably the entire country now just has this lingering suspicion that she's out of her depth, and more to the point.
So at the minimum, we could say that Theresa May is no Margaret Thatcher.
Absolutely, yeah. I mean, exactly. Sort of cometh the hour, cometh the woman, and there's, I think what one of your politicians said, "Sir, you are no Margaret Thatcher."
Yeah, that was, I believe, it was Dan Quayle. I forgot who the other candidate was, and he said, "Sir, I worked and knew John Kennedy. You're no John Kennedy."
You are no John Kennedy, exactly.
All right, well, I appreciate your insight on that. So the Brits are just as confused about what's going to happen there and conflicted as from our view across the pond. Is that the correct?
It's a very, that would be a fair way of putting it. It's a very strange situation. I heard, and I think this touches everything about the culture. It touches media, it touches politics. It's become an all-pervasive topic. And we, in our household, we have a radio in every room, and that radio, each of those radios is tuned to BBC Radio 4, which is like this kind of the adult channel, the grown-ups, and it's sort of talk radio stuff. And BBC Radio 4 had some coverage yesterday, a program called the PM program, and they had an interview with a UK businessman who has an export business. He actually has a manufacturing business, and I'll see if I made a note of exactly what he said, because I was so struck by it. So this is a guy called John Elliott, and he has a company called EBAC, and he said, and in relation to Brexit, he said, tariffs, exchange rates are a nuisance, not a deal breaker. Every time you make a change, there's a cost, but the long-term benefit should be worth the cost. We've just got to sort it out. We've got to move on. The secret to export is not tariffs or trade agreements, totally irrelevant. It's getting a product that customers want to buy, and then you've got to go and deal, and that involves price. And then he goes on to say 56%.
How about, did he mention currency?
No, well, he did
especially
say that
as
currency,
an exporter?
Yeah, no, he did say that currency is clearly one of those factors that you have to be aware of. But he said it's not the be all and end all. And he then went on to say, nearly 60% of UK trade isn't with the European Union. People are behaving as if the entire world was the EU. But people have just lost all perspective on this. And he's saying, we sell to America. I don't know the difference between selling to the USA and selling to France. The key thing is simply getting a decent product that customers want to buy. And in his argument, in his perspective, there's all kinds of businesses, particularly big businessmen, they've got it out of all proportion.
Yeah. Okay. Interesting. All right. So now let's focus on you, Tim. So, I have your website up here, and I know that everyone goes from point A to point B. They have a journey. The journey, that's your first step, the beginning of it. So why don't you tell us a little bit about your history, how you got involved in managing money, and did you have mentors? I know I could see by your site you have gravitated towards the teachings of Benjamin Graham, but why don't you tell us what it was like, I don't know how many years ago, but your first entree into the industry?
Sure. So I came into the financial services industry completely by accident. So I read English at university, and then I originally intended to become a journalist, to work in media in some form. And I started work in 1991. And in 1991, we had a fairly bad recession here in the UK. And the only job I could get was perversely as a bond salesman for a Japanese bank. So slightly unusual outcome. But I spent, roughly 10 years in fixed income sales, and then made the move that really changed things for me, which was to move into private client portfolio management. And that's when the scales really fell from my eyes. So my experience of working for sort of Wall Street firms, I was with Merrill Lynch until 2000, was that you get pushed into narrower and narrower silos, narrower and narrower sort of product specialties.
You're a distribution guy. You're not there. There's no thought or a strategy or tactics or anything.
Well, there's that as well. And there's also the aspect of sort of being a cog in a machine and all of that. But what particularly struck me was that people were being forced into increasingly narrow specialties. So, for example, if you were a trader, a bond trader, you might start out, say, in European government debt trading, but then you'd have to be because of the way the system worked, you'd have to start trading German government debt, and then after a while you'd have to start trading 2 to 3 year German government debt, and it was just so restrictive. But when I made the move with Merrill from trading to, or in my case sales, to portfolio management, all of a sudden private client portfolio management in particular, as I say, that the whole world suddenly opened up. So I'd argue that there's two specialisms, or two roles in the capital markets that give you complete carte blanche, a complete freedom to trade or invest in whatever you like. One of those areas is private client wealth management, and the other is, and I say this as a hypothetical because I've never worked for a hedge fund, but I suspect the only other one that gives you the same kind of latitude is working for a good sort of global macro fund. But absent that, unless you're a private trader, private investor, then the only way you can get, if you like, to sort of to get involved, to play around and sort of really sort of, cast the net widely in terms of markets is to work in a private client environment, because in every other respect, you're forced to specialize in something. I think it's very restrictive.
Okay. So I'm assuming that you made that move to start your own firm from...
Exactly. So that happened. So I started out in portfolio management around the turn of the millennium, and then about 3-4 years ago, finally had enough capital and clients as well, to be fair, to set up a specific business. So that's Price Value Partners, and we effectively have two offerings. So as you correctly infer from the website, we're big fans of Benjamin Graham. So for anyone that isn't familiar with the name, I suspect most of your listeners would be, but the godfather of value investing. So we have a value investment fund, a global sort of Benjamin Graham style fund. But the other offering we only have two offerings. The only other offering we have is a kind of like a discretionary sort of multi-asset offering, which is entirely bespoke. And that's all we do. But in every sense, the kind of value ethos persists. So I'm not sure I can bring too much to the party when it comes to, let's say, short-term trading. But the kind of things that we look at as the day-to-day, value equities is clearly one of them, and that's around the world. And our favorite market at the moment, for example, is Japan. And that's on a valuation basis. But there's plenty of other factors, I think, that make the Japanese market and the yen look particularly interesting. And the other areas that we look at, up until recently, we would have invested in objectively high-quality debt. But now I'd argue that there isn't any left. And even if there were any, the yields are so derisory that the bond market is just far too risky to be deemed investable. So we don't really touch bonds anymore. The other two areas that interest us, one of them is the one type of hedge fund investment that we make, and that's what we would call it uncorrelated investing. But in the US, you guys would probably refer to it as CTAs, or we'd call them systematic trend following. So very much a momentum-based approach. And then the final link in the chain is, well, again, we'd call it real assets, but for real assets, read primarily the monetary metals, gold and silver, because we are convinced that because there is this crisis of debt, there is too much supply of debt in the system globally. Ultimately, the only way that problem can be reconciled is with what I think is going to be a messy inflation. Exactly.
Okay. All right. So we've been waiting for it to rear its ugly head, which has been pretty much buried in the sand for a while. What do you think is going to be the catalyst? Higher energy prices, continued central planning, where perhaps our own Fed backs off of its plans to tighten. What do you think is going to be the trigger for higher inflation going forward?
I honestly don't know, but if I were forced to sort of to single out one specific factor, I think it's perhaps most likely to be currency weakness, and that would clearly be a sort of rotating process, because clearly not all currencies can be weak against each other at the same time. But the rationale, so if I express it, say, in UK terms, to start the point, Her Majesty's government, the UK government, will never struggle to service her sterling-denominated debts, because Mark Carney at the Bank of England will always be able to print money. So for as long as we've got sterling liabilities, i.e. debts, we'll always have a printing press to be able to service that debt. We can't guarantee the purchasing power of the currency, but we can guarantee at least that the money's there in nominal terms, simply to make good on interest payments and principal repayment.
Don't you think with the dollar still remaining the reserve currency, that for this scenario you're talking about, that the negative or debasement of a currency has to happen with the linchpin being the U.S. dollar rather than?
Well, possibly, but I'll just finish off on the UK, and then we can turn over to the US.
Okay.
So from a UK perspective, currency printing is not an issue. It can always happen. Clearly, that's not a luxury that's granted to the central banks of the Eurozone economies, because they're not in control of their own monetary policy. So whereas we, at least in the UK, have that kind of pressure escape valve, in Europe they don't, or in the Eurozone they don't. So that's a big issue, and it may come to be a big issue that ultimately brings down the Euro project. Perhaps from the periphery in, where you get an economy like Italy, where the banking system is completely unreconstructed and probably arguably insolvent, because they can't depreciate their currency the way that they used to in the past. But if we go back to sterling, so the UK, the Bank of England is all over the bond market, what we call our gilt market, and so I'd say that however much our spending goes up, particularly if we get a disaster of a sort of Labour government under this guy Jeremy Corbyn, no matter how much debt needs to be issued, the Bank of England can practically infinitely buy this stuff under its quantitative easing program. If you accept the logic of that, then the only market that I think is big enough for traders to express a judgment call on, say, fiscal credibility is currencies, because the one market that's bigger than every central bank is the currency market. So I expect, in as much as, because I mean, trying not to sound overly like a conspiracy theorist, the reality is that there's an enormous amount of market, let's just call it market manipulation going on through QE, through quantitative easing and having a more or less zero interest rate policy. The one market that I'd suggest is too big, even for the world central banks, concertedly to dominate, is the currency market, is foreign exchange. So if, for example, we get, say, I mean, the disaster scenario for the UK is that we get a Labour government and we get a return to the 1970s and sort of economic crisis writ large. Then
that was a brain drain. I'm old enough to remember that, right?
Yeah, well, I mean, in 78, 79, what we call our winter of discontent, you had, corpses went unburied, the grave diggers went on strike, rubbish piled up in the streets. We were forced, in 76, we were forced to take to go cap in hand to the IMF for an emergency loan of, I think, $4 billion, which was a lot of money at the time. So those are the kind of things that are potentially ahead for the UK as in a sort of return to the 1970s. But the one market that the Bank of England can control is interest rates, is the gilt market, is market interest rate, and it can sit on the entire yield curve if it wants. But the one market it can't control, and we saw this in September 1992 when sterling was ethnically cleansed from the exchange rate mechanism in Europe, is the currency market. So what I'm wondering
why can't the Fed, if you contend that the BOE can control the whole curve, why can't the Fed do something about the flattening of the yield curve here in the U.S.?
That's a very good question. But I mean, one thing that Janet Yellen has said, and whoever's going to replace her is likely to say is it's now become kind of like market accepted wisdom that the Fed's now in call it tightening mode. So we've already had a few rate hikes already, albeit baby steps and sort of 25 basis point tightening. But also it's accepted that the Fed for the foreseeable future is into we'll forget tapering. It's tapering. So it's actually a final reversal of all the stimulus we've had for the last 7 or 8 years. So
in the light of reversing the balance sheet.
Exactly. So on that basis, it would be inconsistent for them suddenly to start playing games with the yield curve. But you're absolutely right; they could certainly do that if they wanted to.
Okay, so it's more of about their will to not want to play with that.
Well, I mean, my colleague Killian, who works with me in the business, says that he does not underestimate the kind of dogmatism of central bankers right now. And I mean, I can't speak for the US, but I can tell you in the UK, even with interest rates at 5,000-year lows, there are millions of people who can barely afford for the interest rate cycle here to turn up at all. So in other words, you've got so many people on, who have mortgages
leverage
on, let's say, a variable rate, and they literally cannot afford for rates to go up even by a quarter of a point.
Like governments. Including governments.
Conceivably including governments, but again, governments are playing all these games for their central banks, so you're not seeing a fair market price in the bond market at all. But for those people, I mean, for those people who have mortgage-related debt, there is a huge cohort of people who are going to be made borderline insolvent or bankrupt if we get the tiniest rate hike here. So then you have an existential question: if it's too politically painful for rates to go up, can rates go up? And I'm not sure we know the answer to that question. But the US has already shown, the Fed's already shown that you can tighten this thing, because we're at that gentle upturn in rates has already started. And this is the thing that interests me from an asset allocation perspective. The one iron law in finance is if interest rates go up, bond prices go down. So with interest rates at 5,000-year lows, who on earth would want to be long bonds now, other than those entities that have got no choice because they're forced to own them by regulation?
Okay, so let's just shift. You mentioned Japan. So I have a monthly chart up of the Nikkei, and as bullish as the chart looks, we still haven't recaptured the highs of 1989. Is that kind of a thesis that you have, that most world bourses are making new all-time highs, and yet Japan still is, you know, what, about 20% away from highs?
Oh, it's still 40% below the 89 high. I mean, Japan, I think, is one of the most incredible opportunities for investors at the moment. The reason why we have, you know, such faith, such conviction about this market is not based on some kind of macro view about trying to forecast the market direction. It is predicated quite straightforwardly, simply on bottom-up valuations. So a third, I think something like a third of the entire TOPIX index trades below book value. Japan is the cheapest developed market in the world, and yet, and as you say, it's well away from the highs that we last saw in '89. At the same time as every other major market in the world has barreled higher over that period. So it makes Japan look even worse. The underperformance is so much more startling. But from our perspective, the rationale for Japan is as follows: it's the third largest economy in the world, and yet it's being given away. It's the cheapest market. It's cheaper on, for example, a forward price earnings basis than either the US or Europe. But one of the other reasons we like it is as far as I was in Tokyo earlier this year, so I can speak to some of this anecdotally. There's a kind of consensus out there that Abenomics hasn't worked. We'd completely disagree with that from our perspective, particularly in like small and mid-cap Japan. There are lots and lots of Japanese companies that are away from everyone's radar, under the radar, that are quietly making record profits now. But you're not necessarily hearing about them because people, I think it's because it's a kind of...
that's going to be a wrap for today, guys. Oh, you're there. Okay, Tim. So, yeah, lost you for a minute.
No. Can you still hear me? Hi.
Yes, I could hear you.
Yeah. So as I say, you know, Japan just strikes us as being screamingly cheap, and yet you've got these other factors that are helping it out as well. Namely, you know, you've got Japanese companies restructuring, they're paying higher dividends, they're buying back their stock aggressively. It's like, what's not to like about this market?
The demographics.
That's true, but then okay, to your demographic.
That's the only thing I could come up with.
To your demographic argument, I'll say, okay, well, they're going to give you the world's most sophisticated robotics technology, then, aren't they?
That's a good one. So do you have an outlook on U.S. dollar yen with your outlook on, you know, stocks trading below book on topics?
We've hedged about half of our yen exposure within the fund because we've got about 40% of our fund allocated to Japan because we like it that much. But we've hedged about half of that exposure. Having said that, it seems to, I mean, so we don't trade currencies, but it seems to us that there's a plausible thesis that the yen is now in a new bull market, and yet we think there's equally a plausible likelihood that the Nikkei and the TOPIX are capable of rallying even with a market where the currency is strengthening, and that hasn't been the case for some time.
Oh, interesting. So, all right. So if there, you know, a lot of people trade U.S. dollar yen, the strength comes in during risk aversion here, and then people go into bonds and sell equities. And really, have you noticed the underperformance of U.S. dollar yen? It hasn't been going up, hasn't been going down, very much sideways, while the Nikkei, normally the yen would participate and weaken with the move in higher in the Nikkei. What do you think is behind it, not that correlation kind of breaking down?
I don't have a strong view. I mean, the only thing I would add to that is you're seeing all kinds of quite freakish market behaviors in a number of markets this year. I think I'm right in saying that the stock market has actually been less volatile than the bond market in 2017. And if that's true, that's kind of incredible.
It is. So we live in incredible times, and it was an incredible interview. I'm really glad I reached out to you on Twitter, Tim, and I'm showing Tim's website. So do people have to be from the UK to retain you, or can they be from anywhere?
We can't unfortunately accept subscriptions into the fund from US persons, but we're more than happy to work with Americans in our discretionary business. So we're happy to engage with US people.
Okay. Okay. And minimum accounts?
Effectively, for the discretionary service, $500,000.
Okay. All right, Tim. And the best way to follow you, they can keep in touch with what your thoughts are at Tim.
They can get it all by the website.
Right.
Just mooch around on the website.
Okay, Tim. Well, I want to wish you happy holidays, Merry Christmas, and great, prosperous 2018 in this freakish market environment.
And to you, Dale. All the best.
All right. Thank you, Tim. So that's a wrap. Everyone thank Tim. Check him out. To me, it looks like Tim really has a handle on what's happening out there in the globe. I want to thank everyone for their attention today. We'll see you tomorrow for the NFP. We'll see if the U.S. government can get their act together and not have a debt ceiling problem. And also, I have a great guest, Akil Stokes. My friend will be with us for our interview. Good hunting the rest of the day, everyone. Remember, the markets will be here after the NFP tomorrow. Make sure your equity is. And above all, don't just count your pips, count your blessings. Thank you, investing.com, for broadcasting us live. Adios, my trading warrior brothers and sisters. Thank you, Tim.
Pleasure. Thanks very much.